Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market rebound or dead cat bounce, diverging bank views and approaching risks. This video presents a direct informational narration of the source document. So, let's set the stage. As of Monday evening, June 8th, 2026, we're looking at a pretty mixed bag across the four major indices. The Nasdaq actually showed some real strength, managing to recover about half of its previous drop. And the semiconductor index? It did even better, clawing back roughly 2/3 of its decline from last Friday. But, and this is a big but, the rally in the broader indices really started to fade later in the day. We saw selling pressure step right back into the picture during that final trading hour. What does this tell us? Well, it points to a potentially volatile trajectory for individual stocks as we move through the rest of this week. Today, our analysis is broken down into 5 key areas. First, we'll look at macro data and rates. Second, we'll dive into Nasdaq breadth and history. Third, Wall Street's diverging views. Fourth, the looming mega IPO liquidity drain. And finally, the technical outlook. All right, let's jump right into Section 1, macro data and rates, specifically focusing on inflation and employment. Starting things off with the macroeconomic picture, we've got the latest data from the New York Fed's May Consumer Survey. Now, on the inflation front, expectations for the one-year mark actually ticked down slightly, moving from 3.6% to 3.5%. Meanwhile, the 3-year and 5-year inflation expectations, those held perfectly steady at 3.1% and 3.0% respectively. But here's where it gets interesting. The labor market expectations have measurably weakened. The perceived probability of finding a new job if you lose your current one, that dropped by 2.3 percentage points, down to 43.7%. To put that into perspective, that is the lowest level we've seen since December 2025, and it falls well below the 12-month average of 46.8%. On top of that, the expected probability of losing a job over the next year actually crept up by 0.5% to 15.1%, pushing it above its 12-month average. So how is all this impacting the money markets? Looking at the pricing for U.S. interest rates through the rest of 2026, markets are currently pointing to an approaching 70% probability of a 25 basis point rate hike by October. And by the end of the year, that hike is practically fully priced in. This forward pricing in the money markets is absolutely crucial right now, especially as we wait for the upcoming CPI data release. You see, while the imminent mid-June quarterly Fed meeting probably won't alter expectations too fundamentally, that upcoming CPI report could heavily influence how rates are priced over the longer term. It is so important to keep an eye on these market yields, like the 10-year Treasury yield, because they represent actual capital positioning. They're real money votes, rather than just relying on varying public statements coming from the Federal Reserve. Moving on to Section 2, Nasdaq breadth and history, where we'll explore underlying breadth and statistical outliers. Despite the rapid market gains we've seen since April, the underlying market breadth is still exceptionally poor. Index performance right now is incredibly concentrated, heavily weighted toward the semiconductor sector, specifically memory-related stocks, which, by the way, are also driving the bulk of the S&P 500 EPS upward revisions. Let's look closely at the Nasdaq 100's recent rebound of 1.58%. The actual underlying breadth there was pretty unfavorable. Only 49 constituent stocks advanced, while 51 actually declined. More than half of the entire index's upward movement was driven by just 5 companies: Micron, Intel, AMD, Tesla, and NVIDIA. So essentially, when we talk about broader index performance right now, we are really just talking about the semiconductor sector. Now let's add some historical context to this highly concentrated market. Recently, the Nasdaq 100 took a pretty severe hit, dropping 4.77% on a Friday. The historical data paints a very clear picture of what usually happens next. Over the past 30 years, a drop of 4% or more on a Friday has only happened 22 times. And in 17 of the previous 21 instances, the index went on to break that Friday intraday low on the very next Monday. It goes further. In 19 of those 21 instances, the index closed below that Friday low by the close of the following Friday. So based purely on historical reference, when the Nasdaq 100 falls 4% or more on a Friday, there's literally a 90% probability of breaking that low within the following 5 trading days. Of course, there are always rare statistical exceptions to the rule, where a V-shaped recovery steps in and delays that low from breaking. The first notable outlier was on May 10, 2022, where it took 15 trading days to break the Friday low. The second one was way back on April 6, 2001, which took a massive 104 trading days, experiencing a substantial rebound before finally heading back down. Now, while historical stats never guarantee an identical future trajectory, they are absolutely critical structural metrics. You have to remember that quantitative programs and hedge funds directly base their trading algorithms on these exact probabilities. So, in a way, these statistical expectations inherently drive the trading behavior we see on the floor. Let's transition to Section 3, Wall Street Divergence, looking at the bullish versus bearish perspectives. Following all this recent tech-led volatility, major Wall Street strategists are showing some serious divergence in their outlooks. Starting on the bullish side, Morgan Stanley is holding firm on a year-end target for the S&P 500 of 8,000, which suggests an expected upside of over 8%. Their view is really driven by broad upward earnings revisions and favorable macroeconomic data. They are forecasting that investors will eventually rotate out of those crowded semiconductor and AI positions and move into non-discretionary and transport sectors. Citi is singing a similar tune, having just upgraded its year-end S&P 500 target from 7,700 to 8,100, attributing that revision directly to substantial upward adjustments in earnings expectations. On the flip side, we have Bank of America maintaining a much more bearish year-end target of 7,100 for the S&P 500, which implies a 6% downside from current levels. They're pointing to an excess of warning signals, particularly noting that high PE stocks are vastly outperforming low PE stocks, which to them indicates overspeculation. They argue that long-term growth expectations have just become way too optimistic, creating a severe imbalance in risk-reward profiles that leaves the market highly vulnerable to any earnings disappointments. Meanwhile, JP Morgan is taking a cautious defensive stance. They're warning about continued short-term market weakness, citing potential further sell-offs in the AI, tech, media, and telecom sectors, alongside high bond issuance and low retail participation. They conclude that playing it safe defensively is the rational move until this tech sector volatility stabilizes. All right, moving into Section 4, the mega IPO liquidity drain and associated liquidity risks. So, what's a major structural risk approaching the market? It is an impending wave of mega IPOs that are poised to drain a massive amount of market liquidity throughout late 2026. The sequence kicks off with SpaceX, pricing on the 11th and expected to start trading on the 12th at an estimated $1.75 trillion valuation. And it doesn't stop there. We're expecting filings from OpenAI in September and Anthropic in October, both targeting valuations right around the $1 trillion mark. Plus, you've got high-growth entities like Databricks and the payment firm Stripe, which is seeking roughly $170 billion, also slated to list. Cumulatively, these entities could push total IPO supply to an immense $4.5 to $5 trillion, with the vast majority heavily concentrated in the second half of the year. History tells us that this kind of concentrated IPO supply strongly correlates with peak market valuations, maxed out buyer sentiment, and a general willingness to pay premium prices. It's often a critical early warning signal of market tops. Let's look back at March 2000 during the dot-com era. IPO issuance peaked, and subsequently the S&P 500 tumbled 49%, while the Nasdaq fell 78% by October 2002. We saw a similar story with the 2020 to 2021 SPAC wave, which featured over 600 listings and preceded a 25% drop in the S&P 500 over 9 months. Now, one quick note. The high issuance spike you see in 2008 is strictly excluded from this pattern as a false positive. That was bank debt issuance driven purely by financial crisis survival necessities rather than equity IPOs driven by market euphoria. The massive liquidity drain from these IPOs creates stacked tail risks that extend deep into the third and fourth quarters. First up, the SpaceX IPO involves phased lockup expirations. These will happen incrementally from 60 to 180 days out, meaning we're going to see concentrated selling pressure hit the market pretty heavily right around December. Second, after Q2 earnings, the market really has to verify if the big four tech companies are going to revise their massive capital expenditure plans for the upcoming fiscal year. And third, by the time we hit the end of 2026, the market is going to be intensely scrutinizing the actual revenue growth and monetization metrics coming from all those heavy AI investments. These overlapping liquidity and fundamental risks definitely require strict tracking. That brings us to our final section, Section 5, the technical outlook and short-term pivots. Regarding short-term technical conditions, the market is currently sitting right at an objective midpoint. In the short term, direction depends strictly on breaking last Friday's high or low parameters based on closing prices. If the index breaks below Friday's low, it's a clear signal of continued selling pressure and a deeper, unresolved retracement. But if it breaks above Friday's high, that would relieve the immediate panic from the recent sell-off. In the meantime, any sideways, low-volume action we see simply indicates an intentional hold. Market participants are basically waiting on the sidelines for the upcoming CPI data release and assessing the tangible liquidity impact of the SpaceX listing before they commit their capital. To wrap things up, let's touch on some specific sector developments. The Semiconductor Index, or SOXX, managed to successfully hold its lower trendline support right on the open, temporarily avoiding a definitive breakdown. However, that level is going to require continuous monitoring. Furthermore, if we look at historical patterns, Apple's WWDC event frequently triggers a classic sell the news market reaction, so that's something to watch out for. And lastly, there are some unconfirmed single-source reports floating around suggesting that Google and NVIDIA might be considering Intel as a secondary manufacturing partner, with potential order deliveries projected for 2028. These fundamental updates really form the immediate operational backdrop as we head into the coming sessions.